Welcome to the Pro Ticker Deep Dive.
Glad to be here for this one.
Yeah, if you are listening to this right now, I really hope you're sitting down or at least somewhere where you can take a deep breath.
You're going to need it today.
Because it is Friday, February 20th, 2026, and, well, the street is calling today Macro Friday.
Which honestly feels like a massive understatement.
Right. Macro Friday is definitely the polite version of what traders are typing in the chat rooms this morning.
Oh, the atmosphere out there is electric. I'd even say it's bordering on frantic right now.
Completely frantic.
We are witnessing a convergence today that we haven't seen in maybe, I don't know, a decade.
At least a decade.
It's financial, it's political, it's military, and they aren't just brushing up against each other. They are slamming together at full velocity.
It feels incredibly heavy. You can just feel the tension looking at the pre-market data feeds. I mean, we woke up to this massive data deluge hitting the wire.
Just a wall of numbers.
Right. The Personal Consumption Expenditures Price Index, the PCE, which, as you know, is the Fed's absolute holy grail for inflation tracking. And we got the Q4 2025 GDP numbers layered on top of that.
And, in a normal week or even a normal year, we would probably spend this entire deep dive dissecting just those numbers.
Absolutely. We'd be arguing about decimal points on core inflation.
Yeah, debating whether the GDP deflator was running too hot.
But today
Today it doesn't even matter.
those numbers are wallpaper. They are literally just background noise to a fundamental regime change in how the global system operates.
It's wild to hear you say that GDP data is background noise, but you're completely right. The real story here is this structural shift.
A total upheaval.
We are talking about a complete upheaval at the Federal Reserve. We have this bizarre split in the stock market where industrial tractors are somehow crushing the quote-unquote future of finance.
Yeah, the divergence is fascinating.
And we have a geopolitical map that is being violently redrawn everywhere from the ice sheets of the Arctic down to the deserts of the Persian Gulf. It is an overwhelming amount of information to process for anyone. We have a new Fed nominee that triggered a historic crash in gold overnight.
Unbelievable price action there.
We have U.S. military ultimatums being issued in the Middle East. And somehow, incredibly, we are back to discussing the purchase of Greenland.
Right, and unlike those internet memes from a few years ago, nobody's laughing about Greenland this morning.
No, not at all. It is deadly serious,
Right.
and the strategic implications are massive.
So here's our mission for this deep dive. We need to connect all these dots for you. We need to explain exactly how a leadership change at the Federal Reserve, a John Deere tractor sitting in a cornfield, and a military base in Greenland are all part of the exact same story.
They are all tied together.
It's a story about inflation, it's about growth, and it's about this new world order that just seems to have arrived while we were sleeping.
The overriding theme here is what I'm calling hard reality.
Hard reality, I like that.
We are moving abruptly from a long period of soft expectations and easy money into hard reality.
Okay, let's start with that hard reality at the Federal Reserve then. The headline screaming across literally every terminal this morning is the Warsh shock.
A war shock, yeah.
But before we get to Kevin Warsh and his grand plan, we really have to set the stage. We have to talk about the empty chair. We need to talk about Jerome Powell.
You really cannot understand the proposed solution without first understanding the crisis that created it. Jerome Powell is essentially out, and the circumstances around that are incredibly dramatic.
Truly unprecedented.
We are looking at a Department of Justice investigation regarding renovation spending at the Fed's headquarters.
And Powell has been very vocal about this, right? He's not going quietly into the night.
Not at all. He has vehemently denied any wrongdoing.
He's calling it a political hit job.
Exactly. His argument is that this isn't about drywall or paint or office furniture budgets. He firmly believes this is a direct attack on central bank independence.
A way to force his hand.
Right away for the executive branch to pressure the Fed to cut rates before the underlying economic data actually supports a cut.
But the thing is, regardless of the truth of those renovation allegations, the political reality is all that matters to the market right now.
And the market reality is that Powell is a dead man walking. His influence over the committee has evaporated.
And this paralysis at the top has left the Fed stuck in this, what they're calling a patient pause. They have been holding rates steady at 3.50% to 3.75%, even though the market has been screaming, crying, begging for rate cuts.
They've had to hold because inflation is still incredibly sticky. Core PCE is just hanging around 2.8%.
Which is well above that 2% target they want.
Significantly above it. So you have this brutal deadlock, you have a paralyzed chair, You have sticky inflation, and you have a market demanding liquidity.
The total pressure cooker.
It is. And then President Trump drops the hammer and nominates Kevin Warsh to succeed Powell.
And the market reaction to that was just instantaneous. I was watching the metals desk when the news broke, and it wasn't just a dip, it was an absolute bloodbath.
Gold was down over 10%, and silver dropped nearly 30%.
30% on silver.
That is a legitimate crash. We haven't seen a move like that in precious metals in a very long time.
So help unpack that for the listener, because I think the conventional wisdom out there is that when there is political turmoil or a big shakeup at the Fed, you buy gold as a safety trade.
Right, that's the traditional safe haven playbook.
So why on earth are they aggressively dumping it?
Because the debasement trade is unwinding.
Okay, explain the debasement trade.
For the last few years, the absolute dominant bet in the macro world has been that the U.S. government and the Fed will essentially cooperate to inflate away the national debt.
Keep the money printer running.
Exactly. The theory was simple. Deficits are high, so the Fed will keep rates artificially low, they'll print money, and they'll let inflation run hot to manage that debt burden.
And that obviously weakens the dollar, which makes gold shine.
So gold was the ultimate hedge against a loose, compliant Fed.
But Kevin Warsh changes that math.
Completely.
Yeah.
He represents a very hard pivot to sound money. He is not a dove. He is not even a typical hawk. He is something entirely different.
The market looks at Warsh and says, okay, the era of easy money debasement is officially over.
Right, so they sell the gold and they buy dollars.
Which brings us to the core concept of today's deep dive. This is the monetary barbell. I was reading through the notes on Warsh's proposed strategy this morning, and it is fascinating.
It's a highly unique approach.
It's not just raising rates or lowering rates. He's proposing doing two seemingly contradictory things at the exact same time.
It is a hybrid strategy. Think of a physical gym barbell. It has two very heavy weights on opposite ends of the bar.
Okay.
On one side of the barbell, you have aggressive balance sheet reduction, quantitative tightening, or QT. Warsh has been very vocal that the Fed's balance sheet, which is currently sitting at around $6.6 trillion, is fundamentally distorting asset prices.
And he wants to cut that by, what, $3 trillion?
That is the number he floated? Yes. He wants to slash the balance sheet by nearly half. But more importantly, he wants to get the Fed out of the mortgage-backed securities market entirely.
Let's pause right there, because that is a massive shift for anyone who owns a home or wants to buy one. For years, the Fed has been buying mortgage bonds to keep housing rates artificially low. Warsh is saying no more.
Correct. He believes the central bank shouldn't be in the business of allocating credit to specific sectors of the economy, like housing.
Because it creates bubbles.
Exactly. He wants a much smaller footprint. So that is the hard money side of the barbell. It tightens liquidity, it pulls cash out of the system, and it strengthens the dollar.
That is the side that just crushed the gold market.
Yes.
But wait, if you pull $3 trillion out of the economy, you crash the system right. That is a massive contraction. You'd cause a severe depression.
Which is exactly why we have the other side of the barbell, front-loaded rate cuts.
Okay.
To balance the tremendous shock of pulling all that money out via the balance sheet, Warsh plans to cut the baseline interest rates aggressively. We are talking about potentially bringing the federal funds rate down to 2.75%. or even 3.00% by late 2026.
So let me make sure I have this straight. He shrinks the actual supply of money out there, but he makes the money that is remaining much cheaper to borrow.
Precisely. It is a very nuanced maneuver. The underlying logic is that he wants to restore market discipline by stopping the Fed put.
The idea that the Fed will always step in and buy assets to save the stock market from crashing.
Right. He wants to kill that expectation. But he still needs to provide enough operational liquidity for regular businesses to function. He wants a smaller, leaner Fed, but lower borrowing rates for the productive economy.
It sounds really elegant on paper, but to me it feels like a total high-wire act.
It is incredibly risky. And the biggest risk here is what the street is calling the maturity wall.
I saw that term popping up in all the research notes this week. Can you explain the mechanism of that maturity wall?
Sure. Think back to 2020 and 2021. Interest rates were basically at zero. Corporations and commercial real estate firms issued a massive amount of debt because borrowing was practically free.
Right. They loaded up on cheap 5-year loans.
But those loans have term limits. A huge chunk of that commercial debt is coming due right now in 2026. They need to refinance.
They need to pay off the old cheap loan by taking out a new loan.
Exactly. They have to go to the bank or the bond market. And here's the trap. The Fed controls the short-term rate, right? But the market controls the long-term rate. The 10-year and 30-year Treasury yields.
Okay.
If Warsh stops buying mortgage-backed securities and bonds, that's the QT side of his barbell, the market might completely panic. Long-term interest rates might spike aggressively.
So a company might see the headline Fed rate go down to 3%, but when they actually go to the bond market to refinance their factory or their office building, the rate they actually have to pay is sky high because the Fed isn't there as the buyer of last resort anymore.
That is the absolute nightmare scenario. You get what's called an inverted curve where short rates drop, but long rates explode. That would trigger a massive wave of defaults in commercial real estate and any debt-heavy sectors.
That is a true fear behind the war shock.
Yes. So the trillion-dollar question is, why does he think he can actually pull this off without breaking everything?
Because he has a thesis.
Right. He has the AI productivity thesis.
Warsh isn't just a traditional finance guy. He spends a lot of time looking at the tech landscape.
Warsh is a massive believer, and this is highly controversial in economic circles, that we're right on the cusp of an unprecedented AI-driven productivity boom.
He believes that AI will make workers so much more efficient that the overall economy can grow rapidly without causing any inflation.
That is the bet. He is betting the house that Silicon Valley is actually right about these productivity gains. He thinks we can essentially grow our way out of this massive debt problem if we just unleash AI across the industrial base.
Which is just incredibly ironic considering what is happening in the stock market right at this very moment. Because while the incoming Fed chair is betting on AI to literally save the macroeconomy, the stock market is freaking out that AI is going to destroy a huge chunk of the corporate world.
And that perfect contrast brings us to the second part of our deep dive. The severe divergence we're seeing between the real economy and the AI shadow.
This was easily the most fascinating part of the week's data for me. You have two companies reporting, Deere & Company and Blue Owl Capital.
A perfect dichotomy.
One makes physical tractors, the other makes private financial loans. And their fortunes have completely flipped this week. Let's talk about the winner first, Deere.
Deere absolutely crushed it. Their earnings per share came in at $2.42 against an expected $1.92.
That is a massive beat for an industrial.
Huge. The stock is up around 13% on that news alone.
And what really struck me was the narrative coming from their management team on the call. Usually industrial companies are very cautious, they hedge their bets, but Deere came out and said explicitly 2026 is the bottom of the cycle.
They are boldly calling the turn. And look at where the specific strength is actually coming from. It's not large agriculture. That sector is actually still pretty weak, though it is stabilizing.
So who is...
It's construction and small agriculture equipment. Those specific segments are absolutely booming, up 24% to 34%.
Construction. In this high interest rate environment, that seems totally counterintuitive. Usually high rates absolutely kill construction dead.
Right, but it tells you that infrastructure spending and corporate onshoring are real tangible trends. We aren't building high-rise office towers anymore. We are building manufacturing factories, data centers, and heavy energy infrastructure.
That activity is happening in the dirt on the ground.
Yes, but the key point on Deere is their sheer resilience. They are facing $1.2 billion in tariff costs right now.
Which sounds like an absolute profit killer.
It absolutely should be. But they are managing to stay price neutral through internal efficiency. They are offsetting those massive tariffs with operational improvements.
This signals that the industrial economy, the companies that actually make physical stuff, is adapting to this new protectionist trade environment much better than the bears expected.
And they are using technology to do it. Deere isn't really just a tractor company anymore. They are essentially a heavy robotics company.
Right, they have that see and spray technology. Their machines use advanced computer vision to spray only the weeds and not the actual crops.
Which saves the farmer a fortune on expensive chemical inputs. That is the productive use of AI. It's tangible. It's applied directly to the physical world.
So metal machines and tangible efficiency are winning right now. And then we look at the ultimate consumer giant, Walmart.
The absolute behemoth. Their revenue just topped $700 billion annually.
$700 billion. That is a staggeringly large number. That's bigger than the GDP of many mid-sized nations.
And their e-commerce division is up 24% globally.
Which their management says is being driven heavily by Sparky.
Sparky.
Is that their internal code name for something?
It's their consumer-facing AI shopping assistant. This is another prime example of the quote-unquote good side of AI working in the real economy. Walmart is using it to make shopping frictionless, to predict exactly what you want before you search for it, and to massively optimize their back-end logistics.
It's pure efficiency.
Exactly. But you have to note the warning from Walmart, too. Even with all that success, they are flagging serious headwinds from new drug pricing legislation and, again, tariffs.
So the real economy, the tractors, the groceries, it's a tough environment, but they are fighting and they are adapting. Now let's flip to the loser of the week. And this is where the story gets really dark really fast. Blue Owl Capital.
This right here is the critical insight for this week. If you take nothing else away from this deep dive, you need to understand this dynamic. Blue Owl is an absolute titan in the private credit world
And their stock just slid 26%.
because they had to halt redemptions on a major retail fund.
Halting redemptions
Yeah.
is never, ever a phrase you want to hear as an investor. That literally means you can't have your money back right now.
Correct. It creates instant systemic panic. But here is the fascinating nuance. The reason they halted isn't that their borrowers are defaulting today.
The loans are still performing.
Yes, mostly. The reason for the panic is fear of tomorrow, specifically the AI disruption fear.
Unpack that for us because I think people struggle to see the connection.
Right.
Why does an AI coding tool hurt a private credit lender?
Think about exactly who private credit lends their money to. They don't lend to Deere or Walmart. Those giant guys go to the public bond market or massive Tier 1 banks. Private credit lends heavily to private equity-backed software companies.
The SaaS companies, software as a service, the
Yeah.
subscription models. So you pay $50 a month for a seat for your employee to use some HR software or a digital marketing tool.
Exactly, seat-based revenue. That has been the absolute golden goose of the entire tech industry for 15 years. It's recurring, reliable revenue. It's supposed to be bulletproof.
But it's not.
No, because investors are suddenly terrified that generative AI is going to completely kill that business model.
Because the AI is the seat.
Yes. Think about it. If an autonomous AI agent can write the code or manage the HR workflow or handle all your customer service, do you still need to buy 500 individual software seats for your human employees?
No, you might need 50. Or maybe just 5 to oversee the AI.
So if you're Blue Owl and you lent billions of dollars to a mid-tier software company based on the projection that they'd keep selling more and more human seats every year, and suddenly AI makes those human seats completely irrelevant,
Then the software company you lent to has no future cash flow. Their valuation completely collapses.
and your loan goes bad. It's a massive flight to quality happening in real time. Investors are dumping these AI-vulnerable private credit funds and aggressively moving their money into tangible physical assets.
Or dear.
Exactly. You cannot replace a 10-ton physical tractor with a clever chatbot.
That is just profound. We spent all of 2024 and 2025 thinking AI was this massive bubble that would inevitably burst because the tech was overhyped. But now the market is saying, no, the tech is very real and it's going to completely wipe out the old tech companies.
And that realization, that sheer terror, is crashing the credit markets that funded the entire software boom. It's a classic textbook case of creative destruction, but it's happening at warp speed, and it's affecting the actual plumbing of the financial system.
But let's review. We have the Fed trying to tighten the money supply. We have the real economy booming purely on operational efficiency. And we have the software economy facing an absolute existential crisis.
That's a lot.
And if that wasn't enough to process for one Macro Friday, we have to look outside the U.S. borders. Because right now, geopolitics is driving inflation just as hard as the Fed is trying to fight it.
We have to talk about the Arctic front.
Greenland. I have to admit, I honestly thought this was just a recycled internet meme when I first saw the headlines popping up. President Trump wants to buy Greenland again.
It sounds like a late-night talk show joke, but I assure you the military and diplomatic circles in Washington are treating this with deadly seriousness. This isn't just about ego or trying to build a golf course on a glacier.
What is it about then?
It's about a core military doctrine called strategic denial.
Strategic denial. Explain how that doctrine works up there.
The overarching U.S. strategy right now is to keep Russia and China entirely out of the Arctic Circle, period. As the polar ice caps continue to melt, new viable shipping lanes are opening up. The Chinese call it the Polar Silk Road.
And new resources become physically accessible for mining.
Exactly. The U.S. military simply cannot tolerate a Chinese deepwater port or a Russian bomber airfield being built in Greenland. Geographically, it sits right in the middle of the GIUK gap.
Greenland, Iceland, UK.
Right. It completely controls naval access to the North Atlantic.
But Denmark owns Greenland. And they said no to the sale pretty emphatically.
They did say no. And that blunt refusal led to an escalation that we haven't seen in decades between close NATO allies. We saw immediate threats of 25% blanket tariffs on all European goods.
Ouch, that is literally starting a trade war with our oldest friends over a frozen island.
But the threat worked. It forced a massive diplomatic compromise. We are now hearing reliable reports about a framework deal reached with NATO Secretary General Mark Rutte. The specific term being thrown around the Pentagon is the Okinawa model.
Okay, so modeling it after the massive U.S. military bases in Japan.
Precisely. The U.S. likely won't ever own Greenland in the sense of it becoming the 51st state with senators and a star on the flag. But they are demanding and seemingly getting profound sovereign access.
What does that mean practically on the ground?
It means vast, sprawling areas of the island will effectively be under absolute U.S. military jurisdiction.
But why go to the absolute brink of a global trade war just for this? Is it really just about protecting shipping lanes from Russian subs?
It's about the dirt.
Yeah.
It's about rare earth elements, or REs. We briefly mentioned the F-35 fighter jet and the Golden Dome missile defense system earlier.
Right, the high-tech military hardware.
Those advanced technologies absolutely require highly specific critical minerals: neodymium, dysprosium, terbium.
And China currently controls almost all of that global supply right now, don't they?
Almost 90% of the refining capacity, yes. But Greenland has massive, completely untapped deposits of these specific rare earth minerals sitting under the ice. The U.S. desperately wants resource sovereignty.
They want to dig it up on land they control, defended by their own military.
Yes. They want to permanently break the Chinese chokehold on the periodic table.
So to secure the vital minerals for the military, we are threatening a massive trade war with Europe, which inevitably drives up prices for everyday consumers, which creates more domestic inflation.
You are seeing the loop perfectly. Tariffs are inherently inflationary. Massive military buildups are inflationary. And that brings us directly to the other major geopolitical hotspot exploding this morning, the Middle East.
Right. Section 4 of this chaotic morning. We cannot ignore the literal aircraft carrier in the room, or rather, sitting in the Persian Gulf.
The USS Abraham Lincoln Carrier Strike Group is fully deployed. The overall U.S. military buildup in the region is at an absolute peak, and the underlying context is extremely grim.
We are looking at the direct aftermath of the 2026 Iran massacres and the subsequent street protests.
The Iranian regime is highly unstable right now, and historically unstable authoritarian regimes tend to lash out externally to unify their base.
And there are reports crossing the wire of a strict ultimatum.
Yes, multiple sources confirming a 10-day ultimatum for Iran to finally reach a comprehensive nuclear deal or face severe kinetic consequences.
That sounds like a literal countdown to war.
It certainly has the commodities market spooked. There is rampant speculation on the desks right now debating limited tactical strikes versus a full-blown regional conflict. But just look at the energy markets to see the fear. Oil rose 13.6% in just the last few sessions.
13.6% is a massive spike in such a short period.
And this right here is the absolute nightmare scenario for the Federal Reserve. A classic supply shock.
Because if a real war breaks out, or even if the Strait of Hormuz is just temporarily threatened, oil prices are going to scream much higher.
And that drives up the baseline cost of literally everything.
Yeah.
Gas at the pump, agricultural plastics, global transport, winter heating.
So imagine Kevin Warsh's first week on the job. He's actively trying to cut the balance sheet by $3 trillion to stop domestic inflation. But suddenly global oil is at $100 or $120 a barrel purely because of a war in Iran. What does he even do?
He is completely stuck. It's the central banker's ultimate worst nightmare. Stagflation.
Explain that dynamic.
If he raises interest rates to fight the massive oil-driven inflation, he crashes the domestic economy that is already incredibly fragile from that real estate maturity wall we discussed.
Right, he triggers the defaults.
But if he cuts rates to help the struggling economy survive, the oil shock inflation just runs totally wild and destroys the working class.
This perfectly explains the incredibly tense mood on the trading floor today.
It is exactly why institutional investors are in total wait-and-see mode. Nobody wants to hold heavy risk assets over the weekend if a shooting war might start on Saturday night. The market liquidity just dries up because the sheer uncertainty is too high.
It really is a historic convergence of everything at once. Let's try to synthesize all of this for you listening right now. We've covered a massive amount of ground today, from the Fed's basement, to the ice of Greenland, to the tractors in the Midwest, to the Persian Gulf.
I think the best way to frame it is as a three-front war on economic stability.
Okay, lay out the three fronts.
First, you have the monetary front. The Fed is undergoing a radical generational shift. Warsh is coming in to permanently end the era of easy money slash the balance sheet, and try to engineer a highly dangerous hard money landing.
That's front one.
Second, you have the geopolitical front. The federal government is actively driving major inflation through aggressive tariffs like the Greenland dispute with Europe and potential kinetic war in Iran. This fiscal dominance fights directly against what the Fed is trying to do monetarily.
They are pulling in opposite directions.
Exactly. And third, you have the technology front. The market is frantically trying to figure out if AI is a macroeconomic savior, making tangible companies like Walmart and Deere vastly more efficient, or a destroyer that is going to entirely wipe out the software industry and blow up the private credit market.
It's incredibly messy. It's highly volatile. And it really sounds like the old standard playbook, that whole Goldilocks era of low inflation and steady predictable growth, is officially in the shredder.
It is entirely over. We are entering a volatile period of profound regime shift. You simply cannot just buy a passive index fund and go to sleep for 10 years anymore. You have to actively watch these specific macro drivers.
You have to know what the bond yields are doing on a daily basis.
Speaking of which, for everyone tuning in on this frantic Friday morning, there is one specific metric you need to watch today.
What's the number?
Watch the 10-year Treasury yield. It's hovering right near 4.5% as we speak.
Why is 4.5% the magic threshold?
Because if it breaks firmly through 4.5% and keeps climbing, it signals that the global bond market believes structural inflation is here to stay, regardless of what Kevin Warsh tries to do with the barbell.
It means the bond vigilantes have taken charge of the curve.
Exactly. And if long yields spike, it mathematically crushes the valuations of all those big tech stocks, and it absolutely blows up the commercial real estate refinancing market. It is the ultimate canary in the coal mine for the next recession.
4.5%. We will definitely be watching that ticker all day. Before we sign off, though, I really want to leave you with a final thought to chew on over the weekend. We talked about irony earlier, but this specific dynamic just really stinks with me.
What's that?
Kevin Warsh, the new incoming guy, is betting his entire legacy and maybe the whole U.S. economy on the grand idea that AI productivity is going to save us, that it will make the workforce so incredibly efficient that we can handle the pain of tight, hard money.
That's his core thesis, yes.
But right now, today, the sheer fear of that very same AI technology is exactly what is crashing the credit markets. It's literally destroying the financial value of the software companies that were supposed to be the foundational future of the economy.
It raises a deeply provocative question, doesn't it? Are we aggressively betting on a technological cure that fundamentally kills the patient? Can we actually survive the violent transition to this new AI-driven economy without completely breaking the financial plumbing that was built for the old economy?
That is the defining question for 2026. Stay safe out there, stay informed, and good luck navigating this truly historic weekend. Thanks for joining us on the Depth Dive.
Thanks for listening.